What's going on, everybody? Welcome back to another video. Hope you're doing well, feeling great, and enjoying freedom. It's a great day to have a great day. Today, I wanted to talk about and respond to the very common argument, investing is too risky. We're going to get into it, but really quick, just in case you're new, make sure to subscribe for a bunch of videos. Subscribe to my second channel, which is my backup channel for bonus videos. Get yourself some DYDSS merchandise to help support the channel. Try out some G Fuel energy formula, $5 off your first order by clicking the link in the description. And of course, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account any amount. And if you refer 3 friends by August 2nd, aka only 4 days left, they're going to give you a spin on the Webull wheel, which can win you all the way up to $1,000 of free Apple stock. Webull link in the description. Everything is linked in the description. All right, so let me get myself situated here. Now, as I get everything back in my pockets, let me just give everybody a friendly reminder that my videos are more so something to listen to rather than something to watch. So treat it like a podcast or a radio show. I'm just going to be going for a walk through the woods. All right, so I want to talk about how investing is apparently too risky. See, we've all been taught, each and every one of us, whether it be from our families or school or whatever, that you shouldn't invest your money because there's too much of a risk involved. Instead, you should save your money. You should save it instead. What you earn, hold on to it. Keep as much of it as you possibly can. Spend as little as possible and store away as much of it as you can. Most people say in a savings account. Some people say keep it at home. Some people say this, some people say that. Point being is that people say you shouldn't invest, but rather save. Save it. Use a savings account forever. Save it all. Save it, save it, save it, save it, save it. Don't invest, God forbid. This is what people say. Now, the reason they say this is because there is risk involved in investing. If you invest in the most safest or perceived the safest investment you could possibly make, there is still risk involved. You could, in theory, lose money. That's why people say you shouldn't invest. Now, of course, people make it far more dramatic than it needs to be. People make it seem like the odds are against you and you are almost certainly going to lose money. People make it look like there's a bigger chance of losing money than making money. That's actually not the case. Although, it really depends on what type of investment you're about to make. In this case, we're talking about the stock market. Now, there are good ways of going about investing in the stock market. There are bad ways of going about investing in the stock market. Now, I'm not going to talk about all the different approaches you can take, but one way that I personally consider to be very risky is by going with a small number of individual stocks. Picking, 2, 3, 4, 5 of your favorite companies, publicly traded stocks, and investing in them and investing in them only. That right there is something that I consider to be risky, even if it's the greatest company in the world, even if it's the most innovative, creative, problem-solving company in existence that continues to push the boundaries and continues to grow and continues to change the world and continue to dominate their sector. Management can screw all of that up overnight. It could be the greatest company in the world with the greatest products, the greatest services, greatest everything. Greatest of the greatest, can't be topped. Management can blow all of it overnight. In the blink of an eye, boom. All it takes is one bad decision. Now, when it comes to some of the greatest companies in the world, is that likely to happen? No, but it could. So that right there is what I would consider risky. What is considered significantly less risky would be investing in broad market index funds. Now, before we get into that, before we get into what I consider to be a vastly safer way of investing, let me talk about one other risk, and that would be saving. See, people like to say, oh, if you save your money, you're obviously not going to lose your money. You can only lose your money if you invest your money. If the investment doesn't go the way you want it to go, you lose your money. So save your money instead. Here's the problem with that. If you save your money, your currency, your dollars, and you put them somewhere, I don't care if you hide them under your bed. I don't care if you put them in a savings account. I don't care if you lock them up in a safe. I don't care if you bury it in the backyard. I don't care where you put them. But if you hold on to them, you are losing money. Maybe not a dollar amount. If you stick a $100 bill under your bed, 100 years from now, it will still be a $100 bill. It's not going to mysteriously turn into a $50 bill. Sure. But the purchasing power diminishes over time, as it's been for decades and decades and decades, due to inflation. Now, a lot of people, they think inflation is such a terrible, horrible thing. It's actually not. Inflation's only a problem when the economy is not growing at an equal or greater pace, or an equal or greater rate than inflation. Like if the economy's on a standstill and inflation's on the rise, that's a bad thing. But if inflation's on the rise and the economy's growing, the economy's booming, it's not a problem. Average inflation is not a problem, 2 to 2.5%. But regardless of how the economy is doing, saving your money is always a losing game, because even on a good year where inflation is low, 2.5%, you're losing 2 to 2.5% of your currency if it's saved. So no matter what, it doesn't matter what the economy's doing. The economy could be in shambles, the economy could be on a standstill, it could be retracting, or it could be exploding. People making more money than they've ever made before in their lives. Everything's going up. Stock market's going up, houses are going up, businesses are thriving, massive corporations are still doing great, small businesses are growing, everybody's getting pay raises, everything's going right. Saving currency is still a losing game. Because no matter what, there will be inflation. Now, like I said, inflation's not a problem if the economy is growing, but inflation will always be a problem to those saving their money. Because no matter what, even when inflation's low, you're still losing purchasing power. So if you ask me, I think the greatest risk of all is saving currency long term. Now, if you have a savings account, or if you're saving up for a large purchase, that's one thing. That's short-term saving. You're saving up for something, and then you're going to spend those dollars on whatever it is that you're going to buy. Maybe it's a house, maybe it's a car, maybe you're saving up to start a business. Whatever it is you're saving up for. You're saving up for a purchase, that's one thing. If you're saving just for the sake of saving long-term, and your plan is to continue doing so for decades, that right there is a guaranteed losing game. So if you think about it, that's not even a risk. That's a guaranteed loss. That's guaranteeing to set yourself up for failure. You will never, ever, ever come out on top that way. It's not possible. It's never, ever been done. So now that we got somewhat kind of sort of considered risky investing out of the way, now that we got saving currency and how that's a guaranteed losing game out of the way, let's now talk about investing. Investing in what's deemed to be the best way, what's deemed to be the smartest way, what's deemed to be the safest way, and that would be broad market index funds. Now, when it comes to broad market index funds, there are a variety of different ways you can go. I'm not going to get into all the little intricate details about index fund investing, but I do want to say this. If you park your dollars into broad market index funds and you wait 5 years, the odds of having less money than you started with, very, 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 very slim. Now, if you park your dollars into broad market index funds, and ideally continue making contributions, by the way, you don't just put your dollars there and forget about it. You put your dollars there, forget about it, and continue to put a little bit more in from time to time with dividends reinvested, etc., etc., etc. 5 years, the odds of losing money or having less money than you started with, very, very slim. Now, if you do the same thing and instead of waiting 5 years, you wait 20 years, right now, statistically, the chances of having less money, the chances of losing money by doing things that way, the chances of losing money using that particular method of investing, zero. Zero chance. Now, am I saying there is a zero chance moving forward? That's not what I'm saying. I'm saying so far, there has not been an instance where people invested in broad market index funds over the course of 20 years and lost money. The future, who knows? First time for everything, could happen. But so far, that has never, ever occurred. Meanwhile, saving currency just for the sake of currency loses purchasing power every single year. Every single year. The people who do nothing but hold on to their currency, just for the sake of holding on to their currency, have lost purchasing power every single year. Broad market index funds have an average, or the S&P 500 more specifically, has an average annual rate of return of about 10 to 10.5%. Adjusted for inflation brings it to about 8%. Average annual rate of return, about 8%. Adjusted for inflation, with dividends reinvested, about 8%. In the green. Now, of course, there will be years where you see more than 8%. There will be years like 2 years ago where we saw like 25%. Then there will be years like last year where we saw negative 16% or whatever it was. There will be years that are good. There will be years that are bad. There will be years that are incredible. And then there will be years that are terrible. And then there will also be years where we didn't really go up or down, kind of move sideways for the year. Where we started, or we ended right where we started, give or take. But if you collect all of the ups and downs, on average, it averages out to be 10, 10.5%, or 8% if you factor in inflation. So imagine that over the course of 20 years, where so far it has been a winning game. Have people lost money in shorter windows of time? Yes. But with that 20-year window, there has not been a scenario where money was lost. At no point in history have the big-time investors who just funnel their currency into broad market index funds, whether it be the S&P 500, which is 500 of the biggest, baddest, publicly traded U.S. stocks, whether it be the total U.S. market, which is obviously the top 500 and all the other, smaller cap stocks and stuff like that, thousands of stocks all wrapped up in one, or whether it be a total world index, 10,000 stocks all bundled in one. These are broad market index funds. A little bit of everything for maximum diversification, maximum exposure, minimal risk, minimal concentration, broad market index funds. Now, as a reminder, one of many different ways you can go about investing in these broad market index funds, like you could do it in so many different ways. You could do it in a regular investing account. You can do it in a retirement account. There are so many different approaches you can take. So many different platforms, apps, and websites and companies you can go with. One of my favorites right now, or actually my very favorite right now, is Webull, like I said before. So friendly reminder, if you download the app and fund your account, they're going to give you up to 12 free fractional shares just for doing so. And if you refer 3 friends by August 2nd, they're going to give you a spin on the Webull wheel, which guarantees you at least $100 worth of free Apple stock, with the chance of winning all the way up to $1,000 worth of free Apple stock. We will link in the description. Everything is linked in the description. Just a reminder. You only have 4 days left of that promo. So when it comes to broad market index funds, the reason this is considered the way to go is because of the diversification that comes along with it. I'll stick to the S&P 500 just as an example. That happens to be my favorite index. But the S&P 500, the 500 biggest, best, greatest performing, publicly traded U.S. stocks, the top 500 in the country, all wrapped up in one, where you don't have to worry about, oh, what 500 should I pick? You don't have to worry about that. It's all set up for you. You don't have to worry about, oh man, I have to go through all 500 of these companies' earnings reports. I have to evaluate all 500 of these stocks. What happens if number 500 on the list isn't really performing all that well? You don't have to worry about any of that. If number 500 on the list starts lacking, it gets replaced with number 501. The next one on the list that isn't on the list just yet. It gets swapped out by default. You don't have to worry about any of that. It's all taken care of for you. And if you go with an exchange traded fund that tracks the S&P 500, the expense ratio is unbelievably low. It's like 0.03%. So it costs you close to nothing. Decades and decades and decades down the road, close to nothing, with an average annual rate of return of about 8%, with inflation already calculated in. And if you do this with, let's just say, well, if you do this with a regular investing account, just a normal brokerage account, just an everyday, stock trading account, it's a standard one, and you sell at a gain, you're going to be paying capital gains tax. Now, obviously, if you sell within a year of buying, you're going to be paying short-term capital gains tax, which is more money. But if you wait a year or longer, you're going to be paying long-term capital gains tax, which is less. You're taxed at a significantly lower rate than if you were to wait, or if you were to wait a year or more. And that goes for your regular active income tax rate. See, the tax code was written by investors, landlords, and business owners. And the tax code was written for investors, landlords, and business owners. It was designed for us to do this. You should do this, and you should take advantage of that. Why pay more money? Or actually, first and foremost, why lose money? Why hold on to all your currency? The guaranteed losing game. So number one, avoid losing money. 2, make the smartest possible decision to make money. The closest thing we have to a guaranteed success. And 3, pay less in taxes. So that's one way you can go about it. Another way you can go about it is in a tax-advantaged retirement account, like a 401k, but that's typically through a job. You're investing your pre-tax dollars that have not been taxed yet. They go into this account, so you have more money going in than if you were to put dollars in that have already been taxed. Larger amount going in, and it's tax deferred. You don't pay taxes until you've reached the 59 and a half year old mark, when you're 59 and a half years old, and you can start withdrawing. I mean, you can withdraw at any time, but for it to be penalty free, it's a retirement account. You're not supposed to withdraw from it if you're not retired. 59 and a half, penalty free, and you pay taxes later on down the road, then at that point, when you're 59 and a half or older, and only if you start selling. Another way you can go is with a Roth IRA. Maybe your job doesn't offer a 401k, or maybe you don't like the idea of putting pre-tax dollars in and having to pay taxes later on down the road. Maybe you'd rather do it the other way. Maybe you'd rather get paid in your paycheck, your direct deposit hits, the taxes were already taken out, and then you invest the dollars. So you don't want to worry about like, oh, I don't want to do, pre-tax dollars and have to worry about taxes later. No, if you'd rather pay taxes now and put it in a Roth IRA, which by the way, you can set up a Roth IRA on Webull if you want, link in the description, the app I was talking about before. You can invest your post-tax dollars into a Roth IRA. Right now, maximum contribution is $6,500 a year. You don't have to max it out if you don't want to, or if you're unable to. You can put $5 in. It doesn't matter. You could put the dollars that have already been taxed into this account, invest in broad market index funds within this account, and then, same thing, when you're 59 and a half, and you choose to start selling and withdrawing some of the funds, or all of the funds, this time around, instead of it being tax deferred because you didn't pay taxes originally, you already paid taxes going in this time, the Roth IRA, you can cash out tax-free, completely tax-free. That goes for capital gains. That goes for dividends and distributions. It goes for all of that. Tax-free. You pay $0.00. That's the difference between a Roth IRA and a 401k. Obviously, there are pros and cons. If you have the ability to take advantage of both, I think that's the best way to go. Investing your pre-tax dollars into one account, hopefully getting a company match, and making the most of that if they match up to 100%, up to 5%. In my opinion, it's actually irresponsible to not contribute 5%. I think you should. That's a 100% return every single pay period. Now, who knows what the market's obviously going to go up and down, but if if 5% of your gross pay is, let's just say, $50, and you take that 5% and put it into the 401k, and they match that 5%, for every $50 you put in, $100 is ending up in the account. You contribute 5% of your pay, and the company matches that 5%. Your contributions are doubled. That is a very, 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 very special and powerful thing. A Roth IRA, on the other hand, that's something that's solo, that's something that's on your own. There's no company match. And there's a lower contribution limit, $6,500. A 401k, it's like $20-something thousand, I believe. 20,000, I don't remember exactly off the top of my head. But it's like $20-something thousand. A Roth IRA, something that you do on your own, maximum contribution this year, 2023, is $6,500. From what I read, I believe in 2024, it's going to get bumped up to $7,000, which is good. Usually every year or every couple of years, they do bump it up a bit. So as time goes by, you're able to contribute more and more every year or every couple years, which is good. And there's also an HSA, which I just recently got started with. That's another way of going about saving when it comes to taxes. This has an even lower contribution limit. I believe it's $3,850. And if memory serves me right, I just read this last night. I can't remember off the top of my head. I want to say next year in 2024, it's getting bumped up to, I think, could be wrong here, $4,150. From $3,850 to $4,150, I think. Could be wrong there, but it's somewhere within that range. But either way, let's just call it about $4,000. Obviously, it's less than $6,500 for a Roth, and obviously it's less than $20-something thousand for a 401k, but it's still something else you can do to save yourself and protect yourself from, number one, taxes, because you can lower your tax bill or lower your taxable income just by investing in it, because it comes out of your paycheck. If it's through your company, that is. Lower your tax bill. And an HSA, it's not just tax advantaged, it's triple tax advantaged. Lowers your tax bill, that's number one. Two, the money that you invest can grow tax-free. And three, HSA, by the way, stands for Health Savings Account. I just posted a video about that a couple days ago. Go watch that if you want to know the details. But it's a health savings account. So its intended purpose is for health-related expenses. And you don't have to wait until you're 59 and a half to use it on health-related expenses. You can use it at any time. You can use it tomorrow. You can use it when you're 21 years old. It doesn't matter. Tax-free, penalty-free, as long as it's a health-related purchase. Like an ambulance, crutches, stuff like that. Can't use it for, concert tickets or something like that. There's a hefty penalty there. There's a 20% penalty on top of paying taxes. So you lose, a massive portion of your money, but it's a health savings account. You're not supposed to use it for something ridiculous. And that's triple tax advantaged. So imagine taking advantage of that, or all three, by utilizing broad market index funds. Coming around full circle here. Broad market index funds. The closest thing we have to a guaranteed route to success. Something that, according to history, there has not been a single instance where people consistently investing in broad market index funds, reinvesting their dividends, continuing to make contributions over a 20-year window, lost money. Hasn't happened. As of right now, the odds of that occurring, the odds of losing money over a 20-year window with broad market index funds at the moment is 0%. It hasn't happened yet. And realistically speaking, I don't think it will happen yet. 20 years is a long friggin' time. 20 days is a long time in the stock market. Can you imagine 20 years? You know how many obstacles the economy has bounced back from? You know how much we've grown in the last 20 years? And the 20 years before that? Any 20-year window with an average annual rate of return of 8% adjusted for inflation already? Imagine that in a triple tax advantaged health savings account. Imagine that in a tax deferred 401k where your company is giving you an employer match. Imagine that in a Roth IRA. Dollars that have already been taxed, funneled into this account, and later on able to cash out completely and entirely 100% tax-free. Imagine this in a regular investing account where you will be taxed on your dividends every year, but at a significantly lower rate than your regular active income that you make from work. If you make $50,000 a year on the job, You're going to be paying more in taxes than you would be if you were to make $50,000 a year in passive income dividends and distributions. And if you were to sell, you're still taxed, but at a significantly lower rate than your active income job. See, investing is the way. Investing beats saving. And as sad as it is to say, investing beats working. Now, by no means am I saying, hey, quit your job and become a full-time investor. Absolutely not. Keep working full-time. Keep working. If you're not working hard, start working hard. If you're already working hard, work harder. Make as much as you possibly can. Keep as much of it as you possibly can. Spend as little of it as possible and invest the difference, or at least consider it. That's what I'm doing. Now, obviously, I'm not a financial advisor. Nothing I have ever in my life said, especially on the internet, has ever been financial advice. This is just me documenting what I'm doing. But one of the ways I'm going about doing this, I mean, I'm going about it in a variety of different ways, but the easiest way that anyone can begin doing what I'm doing is on a stock trading app. It doesn't have to be the one that I use, but like I said before, the one that I personally use is Webull. Download the app, fund your account. They're going to give you up to 12 free fractional shares just for doing so. And if you refer 3 friends by August 2nd, aka 4 days left, they're going to give you a spin on the Webull wheel, which guarantees you at least $100 worth of Apple stock for free, with the chance of winning potentially all the way up to $1,000 worth of Apple stock for free, which you can obviously hold on to and let it keep on doing what it does, or you can sell it and buy something you'd rather have instead. Webull link in the description. Everything's linked in the description. So when it comes to investing, I'm relatively new. My first day in the stock market was, I think, toward the end of September of 2019. I spent the rest of that year and the first couple months of the following year, 2020, just not really investing much at all, more so dabbling and just kind of getting my feet wet and learning. I spent like maybe those first 6 months with a little bit of trial and error, a little bit of research, a lot of bit of studying. And my goal was to just absorb as much information as possible, learn as much as I can, build up my confidence when it comes to investing, because I didn't know what I was doing on day one. No one knows what they're doing on day one. No one knows what they're doing on day one of anything. You have to learn. You don't even know what you're doing on your first day on the job. No, you have to go through job training first. So when it comes to anything, you got to learn. So that's what I spent my first couple months doing. A little bit of dabbling, a little bit of trial and error, a lot of studying, familiarizing myself with what an expense ratio is, what a dividend yield is, what capital gains are, how to analyze a stock, how to read an earnings report and interpret what all of these numbers mean. Now, by no means am I saying that I'm like an expert analyst at this point. There's a lot I still am unfamiliar with. Every month I'm learning more and more. That's the beauty of this thing. There's always something new to learn. There's always something new to discover. And there's always another method that you can stumble across and familiarize yourself with and decide for yourself if it's something that you want to implement or not. But I'm relatively new to this. Started dabbling the end of 2019, continued dabbling early 2020, and just as I was confident enough to start taking investing a little bit more seriously and get a little bit more aggressive with it, we saw a massive market crash, March of 2020. I took full advantage of that, and it didn't just collapse and bounce back up. It collapsed and it stayed low for most of that year, or a good portion of that year. So I just kept buying in more and more at the bottom of the 2020 market crash. And I spent that entire year taking advantage of those crazy low prices, and I was able to get a lot of individual stocks at the time, because that's before I started focusing on broad market index funds, which is what I do now for the most part and what I've been talking about throughout the course of this video. But I've seen some crazy gains. Have there been a small handful that are in the red today? Yes. Have I picked a couple of duds? Yes. Have I picked a couple of losers? Yes. But the overwhelming majority are either slightly in the green or massively in the green. And when I say massively in the green, I'm talking about well over 100%. Some of which 200%. Some of which even more. A lot of my picks, the majority of my picks, are up. And a majority of the ones that are up are way up. Double-digit, triple-digit returns. And I've sold nothing. I don't plan on selling anything. And my goal was just to hold on to, everything pretty much forever. I'm actually considering maybe selling a few, just trimming the fat, not necessarily to realize some of the gains, not necessarily for that, but mostly just to refocus the portfolio a little bit. I'm considering it. I don't know. Maybe I will, maybe I won't. That's not really something that I'm all that concerned about right now. But point being is that I've sold nothing. I paid nothing in capital gains because I've never cashed out anything. I still hold on to every single thing that I bought. Every single stock, every single index fund. I have every share that I've acquired since the very beginning. And along the road, I opened up a Roth IRA, the tax advantaged, pay taxes or take your dollars that have already been taxed, put them into the account, let them grow tax-free and cash out completely tax-free in retirement. I've been making the most of that this year. This is actually the first year that I'm on track to maxing it out. Last year, I did not max it out. I made a monthly contribution, and my goal wasn't to max it out for the year. I had other goals at the time. And that was before I got this new job and promotion and all that. So now I'm able to max out the Roth IRA. And the year before that, I opened up the Roth IRA at the very end of that year. I think the very end of 2021. So I didn't even have the time to max it out, which was fine. I just wanted to open up the account. And followed by a year, I made monthly contributions. My goal was, I did not plan on maxing it out that year, and I didn't. This year, I am maxing it out. And also this year, I just became eligible for the 401k with a 5% company match. So I'm making the most of that. Am I maxing that out? Am I contributing $20-something thousand a year? Absolutely not. I don't know anybody who can contribute $20,000 of their gross pay and be able to survive. It's a lot of currency. But I am taking advantage of that 5%. And at the moment, I am contributing 5%. Early next year, I will reevaluate and see if I am able to and can afford to contribute more. Maybe bump it up to 10%. I still get the 5% company match. So instead of seeing like my dollars double, or not my dollars double, but my contributions be doubled 100% right off the bat, no, if I contribute 10% and they're matching 5%, then at least I'm still seeing the 50% bump up, which is still awesome. But that's just for retirement. But regardless, all of these different accounts that I've been talking about, whether it be a regular stock trading app like Webull, like I said before, link in the description, whether it be a Roth IRA, which you can set up on Webull, link in the description, whether it be a 401k with your job, whether it be an HSA, a health savings account, regardless, they all have one thing in common for me. They are all concentrating on broad market index funds. That's what I have the utmost conviction in. That is what I have maximum confidence in. That is, at this time, what I am most familiar with and what I personally believe, in my opinion, makes the most sense Again, I'm not saying that this is what you should do. I'm definitely saying this is something that you should consider and look into and make the decision for yourself, but I'm just documenting what I'm doing. And the reason I'm talking about this, the only reason I'm even making this video, is because this is what I'm currently doing. I'm not talking about something that I'm not doing. I'm putting my currency where my mouth is. I believe this is the right way. I believe this is setting myself up for the best chance of success. And in my opinion, I believe this is the closest thing I have to a guaranteed path to success, which is why this is what I'm doing. I'm taking advantage of the tax advantaged accounts. I am taking advantage of the free money that my company is offering to me within a retirement account. I'm doing what I can on a daily basis, working 6-7 days a week, working my friggin' face off now while I'm able to, while I'm young and have the energy that I do, the God-given energy. People think that I'm ridiculous for doing what I do, first of all, but second of all, being able to do what I do. Taking advantage of that and doing what I can to hopefully make as much money as I can, spend as little of it as possible, save as much as possible so that I can invest as much as possible. Does that sound like a risky game to you? Title of the video, investing is too risky. Does it sound like I'm making decisions without educating myself first? Does it sound like I'm doing anything that I haven't deeply researched? No. I have carefully and strategically evaluated, weighed out the pros and the cons, factored in all different types of scenarios that could take place in the meantime. I've crunched the numbers. I figured out approximately what I will have in net worth 20 years from now if I contribute the minimums to all these accounts. I've crunched the numbers and figured out approximately how much I will have in net worth if I max out these accounts or do what I can to get as close as possible to maxing out these accounts 20 years from now. I've weighed out the pros and the cons, and guess what? I've compared to what my life would look like if I don't invest these dollars and save them instead. What if I do things the normal way? What if I say, hey, you know what? I don't want a 401k. It sounds too risky. A 5% company match? No, thank you. A tax advantage Roth IRA? Not for me. Broad market index funds or individual stocks, investing in a regular account where I'm getting passive income? No. Not my style. I'm going to dump it all into a savings account instead, and I'm going to keep it there for 20 years. And I'm going to do things the normal way. I'm going to do things the conventional way. I'm going to do things the way that we were instructed to do things in school. That sounds like a good idea. I'm going to save my currency instead because there's no risk there. Oh, absolutely no risk in saving currency long term. Oh, $100 will be $100 no matter what. True, but the purchasing power of $100 will die, completely crumble, or at the very least, dwindle away slowly but surely, because that's what inflation does to currency. And like I said before, this is the last thing I'll say about this. You know, people say like, how is that? You know, how is inflation a good thing? Like I said before, it's a good thing if the economy is growing. It's a good thing if business is booming. It's a good thing if you're growing alongside the economy as well, because it doesn't matter if 2% of your purchasing power gets taken away every year if your earnings are growing by 2% or more every year. That's what's supposed to be happening. You should be getting a pay raise. I can't imagine going an entire year without the company giving a pay raise. That to me, that doesn't even make sense. But that's why we're told to do things the quote-unquote safe way. Oh, there's no risk. Save your currency, save it for a rainy day. Save it forever, save all of it forever. And do what? Die with a savings account with $1 million in it that can only buy you like $30,000 worth of stuff? What's the point of that? What's the point of $1 million when a loaf of bread is like 15 bucks? That makes no sense to me. That right there is a losing game. What good is $1 million if a little 2-bedroom house in the middle of nowhere is going for $900,000? Like that right there is a losing game. Save it for what? Save it why? When the purchasing power is guaranteed to go down. The dollars in your savings account, like, yeah, sure, you can, oh yeah, but the interest rates. Yeah, I have a savings account too, and yes, I'm riding the high yield wave while I'm deciding how I want to invest those dollars. But that's not for the long term. I'm saving up for an investment. I just don't know what the investment is just yet. And I've only had the account open just this year. It's not something I'm doing for the long term. Interest rates are still high right now, so yeah, I'm riding the high yield wave while I'm deciding how I want to invest the dollars. That's not something I'm going to be doing for 20 years. It's probably not even something that I'm going to be doing for 20 months. Hasn't even been 12 months. I don't even know if it's been 6. It's probably been about 6. But anyway, imagine doing things the conventional way. Imagine doing things the way that we were, told to do things. Do it the safe way. Be safe. Safe doesn't really, make sense when you realize that safe is actually the biggest risk of all. Not even a risk. The word risk implies that there's a chance of a reward. What's the chance of a reward in saving currency? We need to be objective here. We need to be honest. I know a lot of, myself included, and most of the people that watch my video were have close to no faith in the dollar bill at this point. So a lot of us are biased when it comes to talking about this particular subject. If I were to say, oh yeah, is the dollar bill, something that we should, have 100% confidence in decades from now? Most of us would say no. I would assume all of us would say no. But let's be objective here. If there is a very, very, very small reward that could come along with something that we personally don't believe in, we need to be honest. We need to be rational. We need to be objective. We need to acknowledge that, okay, it's probably not likely going to happen, but at least there is this one little upside. We got to be objective here. So what's the upside? What is the small reward that could come with saving currency long term? Objectively speaking, honestly speaking, what is it? There is none. That's not being biased. That's being objective. There is no upside. You're guaranteed to lose purchasing power. So why do that? You're guaranteed to lose money, so why do that? Is there a risk when it comes to investing? Yes. Can you possibly lose money while investing? Yes. Can you possibly make money by saving money? No. That's the thing. One is guaranteed to fail, and the other one has the potential to maybe fail? Would you rather have a guaranteed failure, or would you rather have a nearly guaranteed path to success? That's how I see it. Hypothetical numbers here. One way has a 100% chance of failure. The other way has a, let's just say, 95% chance of success and only a 5% chance of failure. And most people choose the 100% guaranteed chance of failure as opposed to an almost guaranteed path to success. And at this point, it has been a guaranteed path to success over the course of a 20-year window. So why do people Why do people still keep choosing the losing game? Why don't people play the right game? It's because they don't understand how to play the game. They don't understand that there is a game to be played. Think about it. Most people don't know. Most people don't realize. All they know is, oh, don't do that, it's risky. Okay, I won't do that. Oh, okay, no problem. Oh, thanks for the warning. And then they never think about it again. These red flags go up when they hear the word investing. Oh no! Ah, investing! Oh, God forbid. Financial freedom. Ah! Most people don't understand. That's why. Now, I'm not making this video to force people to understand. No. I can explain it to you, but I cannot understand it for you. At this point, if you watch this entire video and you still don't understand, as far as I'm concerned, you don't want to understand. If you do the research and decide for yourself, not for me, then okay. You don't have to. More money for those of us who do want to invest. But if you want to know which way I'm going, if you want to know the path that I'm taking, it's the one that has a proven track record. It is the one that has yet to fail the investor who is long-term investing in broad market index funds. That's the path I'm taking. And I am making the most of every tax-advantaged account that I can get my hands on. So anyway, I want you guys to head on down to the comments and let me know anything and everything related to today's video topic. When it comes to investing being risky, is it risky? I don't think so. Is there a slight risk involved? Yes. There's risk in everything. There's risk in saving. There's risk in investing. There's definitely risk in gambling. There's risk in the housing market. There's risk in the stock market. There's a lot of risk in the precious metal market. There's risk, there's an unbelievable amount of risk in the digital currency market. There's a risk in starting a business. There's a risk in working a regular job. There's risk in everything. But do you consider investing to be too risky? Is it too risky for you? Is the almost guaranteed route to success too big of a risk for you? Head on down to the comments and let me know anything and everything related to today's video topic, and whether or not you agree with me when I said saving currency just for the sake of saving currency long term is an absolute 100% losing game. Let me know in the comments. If you guys enjoyed today's video, please hit that like button. Subscribe if you are new. Subscribe to my second channel, which is my backup channel for exclusive bonus content. Went away. Make sure to get yourself some DYDSS merchandise to help support the channel in the biggest possible way. My phone's acting up right now. Make sure to get yourself some DYDSS merchandise to help support the channel in the biggest possible way. There it is. Try out some G Fuel energy formula. $5 off first order by clicking the link in the description. Over 50 different flavors to choose from. Sugar-free, low-calorie, packed with a whole bunch of vitamins. Absolutely delicious. This is the Miami Nights Pina Colada flavored. I strongly recommend it. $5 off. Link in the description. And of course, last but certainly not least, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account. You can deposit as little as you'd like, even as little as a penny. It still works. It still counts. You still get your up to 12 free fractional shares. I know. I tried. And of course, if you refer 3 friends by August 2nd, you have 4 days left to do this. Just click the little invite button and send it to 3 human beings that you know. It's quite literally that simple. They're going to give you a spin on the Webull wheel, which guarantees you at least $100 worth of free Apple stock, with the chance of winning all the way up to $1,000 worth of free Apple stock, which you can obviously hold on to and keep for yourself, or you can sell it and use the cash to get something you'd rather have instead. Everything will be linked in the description. We will link in the description. Second channel link in the description. DYDSS store link in the description. G Fuel link in the description. And I want you guys to head on down to the comments and let me know anything and everything related to today's video topic. Thank you guys so much for watching. See you next time. Don't you dare stop smiling. Peace.